So, here's the thing. An ETF trading strategy can be really effective when it's based on quarterly institutional adjustment patterns rather than relying on technical indicators. Institutions, by their very nature, have to restore their target allocations every quarter, and they do this in a pretty mechanical way. Most of the adjustment activity gets concentrated in the final 2 weeks of each quarter. What tends to happen is, sectors that have been outperforming will see selling pressure to reduce those overweight positions, while sectors that have underperformed actually experience buying to restore those minimum allocations. Price channels, they really help reveal when sectors are hitting their boundaries, and that's what triggers these adjustment flows. For instance, if the growth sector is pushing up against its upper channel as quarter end approaches, that's a signal for institutional selling, no matter how well that sector has done recently. On the flip side, when defensive sectors are down near their lower boundaries, that's a good indication of entry timing, with institutional buying stepping in to restore allocations. This whole approach removes the need for predictions and subjective calls, replacing them with objective calendar analysis and price structure. The rotation between growth and defensive sectors is actually the most consistent pattern you'll see. Technology, consumer discretionary, and financials, for example, tend to get sold when they've outperformed during the quarter. Meanwhile, utilities, consumer staples, and healthcare typically get bought when they've underperformed. This rotation isn't about making directional bets on the market. It's just institutions mechanically restoring balanced allocations. These recurring patterns, honestly, are what elevate the strategy and make it all about capturing those systematic flows. So here's the thing, advanced strategy actually combines those quarterly windows with the Federal Reserve meeting cycles. When Fed meetings land in the final 2 weeks of quarters, defensive rotation really amplifies adjustment buying. Meanwhile, growth tends to face pre-Fed rotation and quarterly selling at the same time. Multi-factor confluences create the highest probability setups when multiple institutional flows move in the same direction. Understanding these interactions is what separates advanced development from just simple awareness. If you're ready to trade with more discipline, clarity, and confidence, and maybe even predict the market days or weeks in advance, then join the Market Turning Points community and visit stockforecasttoday.com.